Now today what I want to dive into is how you can create a winning strategy in your investment plan come retirement. Good day, everybody. Chris Heerlein here of REAP Financial and a host of Retire Ready TV on KXAN and host of Wealth Radio every Saturday on News Radio KLBJ for over a decade now. Thanks for making this part of your day. Be sure to hit the subscribe button down below. Click the bell for notifications. I drop new content on this channel every Wednesday so you can stay on top of the latest. Now, today what I want to dive into is how you can create a winning strategy in your investment plan come retirement. When you're invested pre-retirement, you're likely investing different than you will be post-retirement. So what I want to really make sure we discuss is how the most successful investors have positioned their investments for winning in retirement. Keep it right here and be sure and stay with me to the very end because I'm going to talk to you about something that nobody considers but absolutely should. So we're talking about winning strategies in your investments. Well, it starts by having an investment strategy that takes into account markets that go up and markets that go down. When you're invested in your earlier years, in your working years, you got paychecks coming in, we don't like market downturns, but typically this is money you're not going to use for years to come. And if you sit tight, you don't time the market, and you don't let emotions drive your investment decisions, you've seen that these markets come back and more. So part of a winning investment strategy is to take emotions out of the equation. This is why so many successful retirees work with fiduciary advisors like our team at REAP Financial, because they don't want to do this in retirement. They don't want to sit around and watch it daily, hourly. No, that's no way to live in retirement, but they need to ensure that it's positioned in a way that's going to last as long as they do. So taking emotions out of the questions is number one. Number two is having an investment mix that is doing all sorts of different things, not only from a gain and loss perspective, but also from a taxed or no taxed perspective. Let's talk about winning and losing. Well, there's a lot of different types of investments that you can hold in your IRAs, 401ks, brokerages, and more. Some investments are going to be conservative, some are going to be aggressive. Generally, the way we approach it is think about risk in retirement. Think about risk as a tool. And when you don't need it, in many cases, you want to get rid of it because it's costly. But in this environment, inflation is very high. Cost of living is very expensive here in Central Texas. And so putting all the money in a checking or savings account is not a good long-term plan. So risk is something that we still have to take, even in our retirement years, but we want it to be managed risk. And so you need to have an investment mix that is doing different things. If the market's going down, what in your portfolio is going up? If the market's going up, do we have enough skin in the game to ensure that you're going to see meaningful growth to keep up with the money that you're pulling out year over year? What I'm telling you is we don't want you swimming naked in your investments. There's no reason to do that. There's unique tools that a lot of retirees are unaware of, many of which the most successful retirees use today. Let's talk about a few of those. These can be part of a very well-diverse plan and a winning strategy. And we'll start with multi-year guarantee annuities. A lot of different types of annuities out there. The wealthier you are, the more likely you don't need an income annuity or an index annuity or a variable annuity, but you may want a multi-year guarantee annuity because these work very similar to CDs. They come in 1 and 3 and 5 year durations, all the way up to 10 year. Generally, we like to see maybe between 1 and 5 years. And these pay a fixed rate of return. As of 2024, we're seeing 6%. As a fixed rate of return, that's an annual rate of return, and it's fixed for the period of time that you enter into the contract. So it could be 1, 3, 5. At the end of those terms, you're just going to cash out. The benefits of a MIGA as compared to a CD, you may be saying, Chris, that sounds very similar to CD. They are very similar, but there's some key benefits that the MIGA offers, the multi-year guarantee annuity offers, that the CD does not. First one is it's litigation proof. So it's off the books. In the event of a worst case scenario or litigation, it's not going to be subject to claim. Something that's more important for those of you that have high income or most of your income is coming from IRAs and 401ks is controlling your tax bracket. The money that's in a CD, you can't touch, right? Because it's in a term contract. But you still get a 1099 and you're taxed on that money every single year. It's money you're not even touching. Money you can't touch, but you're paying tax. With a MIGA, multi-year guarantee annuity, the money grows tax deferred. You don't get a 1099. You can roll this MIGA over at the end of the term to a new MIGA. And if done correctly, you can take your basis, everything you put in, and all the gains, and move it over tax-free and continue to defer the tax for years and years to come. It helps you control your tax bracket. So that strategy that I just discussed, it focuses on two things: steady, conservative growth, and tax efficiency. Don't forget that it's about what you keep, not about what you make. It's all about the net. Now, another strategy is real estate. Real estate can be bought in IRAs, even in your Roth IRA, or it can be bought with your brokerage assets, cash and beyond. We like real estate in a portfolio, particularly here in Central Texas, because we kind of got our finger on the pulse. We know what's going on. And real estate has shown to be rather steady when you compare it to the equity markets. You got to be careful. We don't want to sink too much money in bricks and mortar. One of the biggest problems we see with real estate investors is they've got nothing in the bank, nothing in investments, everything's in bricks and mortar. Well, you may say, well, hey, I know what it is. It's tangible. I can drive by it. I can see it. It's cash flowing. Yeah, but you got to have liquidity in retirement. You got to have something to live on. So you got to find that balance. But again, part of a well-diversified plan is having assets that aren't losing money when the stock market's going down. MIGAs, CDs, real estate can play that role. Then one that very few retirees are aware of, and it's called buffered ETFs. There's a lot of different investments out there that you hold in your 401ks and IRAs, mutual funds, stocks, and exchange-traded funds. ETFs, exchange-traded funds, and you can actually get buffer on these ETFs that provides downside protection. So it allows you to be in the game and not swim naked. I'll give you an example. If you have a 10% buffer and you're in the S&P 500, these buffers can give you that 10% down protection. So the market fell 12%, you'd only be down 2. The market fell 20, you'd be down 10. Now, you can see up to 15 and 25% buffers. We utilize these in our successful families' portfolios. With these deeper buffers, 15 and 25%, yeah, if the market falls 30, you'd only be down 5 if you had 25% downside protection. But there is some downside to the buffer ETF strategy, and that is you're not going to get all the upside. Traditionally, the more money you want protected on the down, the deeper the buffer, the less you can make. So it's a balancing act. There's a little tug of war. Deeper the buffer, the less growth opportunity. So we have families that utilize 10, 15, and 25% buffers as part of their portfolio. Then you've got assets, maybe in equities, maybe in stocks, maybe dividend stocks, that aren't going to give you the downside protection, but no limitation on the upside growth. Now, stocks, mutual funds, exchange-traded funds, when it comes to the tax landscape, all these things work differently. If you have dividends coming off of your portfolio, good for you, but we want to make sure that you're not paying tax on money you're not using. I can't tell you how many times over the years families will sit down with us, we take a look at the tax return, and we look at line 3A and B, and it shows us that they have qualified and ordinary dividends. This is income that many times you're just reinvesting, but you're paying tax on money you're not using. One of the quickest ways to reduce your tax burden while you're working and in retirement is to manage your ordinary and qualified dividends. Ordinary dividends are taxed at ordinary income rates. Qualified are taxed at favorable cap gains rates, like 15 and 20% at the max. And the thing is that you have to hold these stocks or dividend producing assets for a minimum of 12 months for them to qualify as qualified. So what we see is a lot of people may have an advisor or a broker that's buying and selling in the account throughout the year, generating capital gains, generating ordinary dividends, And you've got to really measure with the tax implications, the amount of fees and taxes I'm paying for this active management. Does it make sense? Is the growth that is being made offsetting? Does it have, the benefits that are really part of your long-term plan? So we want to be looking at everything through the tax lens first. I can't tell you how important it is to have a tax-efficient investment strategy, because again, if you're making double-digit returns every year and you have no plan to keep the returns via taxes, you're totally going to miss the boat on this. Quick tip here, be sure and go to reapfinancial.com. That's reapfinancial.com to download great retirement resources. Is at no cost for our YouTube followers. That's at reapfinancial.com. And be sure and leave your questions and comments below that you want me to answer in future videos. The number one tip that you can't afford to miss is this. If you want to create a winning strategy in retirement, you got to focus on the most important number. Many of you may think it's rate of return. You may think it's the inflation rate, how much you're going to get on your Social Security benefit. The most important number is none of those. Ready for it? It's your budget. This is the most important number in your retirement plan. Doesn't matter how much you saved, really doesn't. You have to identify if your portfolio, your investments can sustain the number you need to maintain or even increase your lifestyle in retirement. This is where people get tripped up. They've got millions of dollars saved, but they're spending $10,000, $15,000, $17,000 a month. And the money over 20 and 30 years of retirement cannot sustain these types of withdrawal rates. So it starts by building a budget. And if you're gonna do this, you start by building your budget today and then also a post-retirement budget, because things will change. You may not be driving to work and using as much gas. You may not be eating out as much. In fact, you may be eating out a lot more because you got a lot more time to fill. You may take on hobbies, maybe starting a business, things that you weren't doing in your working years. So you make sure you got a pre and post retirement budget. We start there. You'd be shocked how much you spend in certain areas. And then we can plug that number in and identify if your portfolio growing at a conservative rate of return with a conservative inflation rate, can it maintain that? It's one of the quickest ways to identify if you're set up for success. But don't miss this. The budget is the most important number in your plan. And nobody wants to live on a stringent budget. We don't want you living like that. We want you to spend your money with confidence. But this is a number that must be monitored, recalibrated throughout the retirement years as things change. Okay, so to learn more about why your budget is key to a winning strategy, click here to watch more.